Good morning. It's Mary Ellen McGonigal, and this is the MEM Edge show. And this is the show where we put you in front of stocks as well as industry groups, in front of areas that are on the move, always with an eye toward capturing these stocks that are poised to outperform and outpace the broader markets. And so, welcome. Today, we have a couple of items that we, of course, will be covering here. And the first thing we're going to do is go ahead and review the broader markets and what the dynamics. There are certainly dynamics that are taking place in the broader markets as we slog through this earnings season. So we'll take a look at that. And then, of course, we are going to take a look at where the strength is in the markets. And of course, by strength, we want to know where the outperformance is with an eye toward a continuation of that outperformance. And then we are toward the end of earnings season, but there are still a number of companies that are due to report today. So we're going to take a look at some earnings setups that look attractive going into earnings. Now, trading stocks prior to companies reporting is not for everyone because, of course, we're not without that crystal ball. We're not quite certain which way the stock is going to report and then respond. But there are clues, there are ways that you can get a sense based on history that a stock very well could come in and report strong earnings and pop. It's really going to be dependent upon your style because oftentimes these stocks that do come out with good numbers, you still have time to enter the stock. They're not just one-day wonders, if you will. And then, of course, as usual, typical catalyst that spark momentum. That is going to be something that we're covering here each week as we move through not only the broader markets as well as some individual stocks. So let's go ahead and get started. What I wanted to do was, as usual, start with a broad overview, bigger picture look. We're looking at a daily chart here of the S&P 500. And what I wanted to point out to you here is that the uptrend is very firmly in place. And I use a lot of simple moving averages when I'm looking at broader markets. The green is a 10-day, the red is your 50-day, and then we have a 200-day simple moving average. So we do have all of your moving averages trending upward very constructively. I did point out here that last week we had a little bit of volatility. The index did dip back below that critical 2,800 level. For those of you that have been following this closely, that 2,800 was a level that took us back to prior highs, and a break above that was very constructive. It was viewed as yet another step toward the S&P fully recovering from that correction earlier in the year. A full recovery, of course, would be the index breaking to a new high. So we had that break last week below 2,800, dipped just for that one day. And sure enough, it was able to rebound and we're back on firmer footing again. The markets are in a very strong uptrend. And let's take a look at the NASDAQ. The NASDAQ, as many of you know, has been leading the markets. This index hit a new high well before the other indices, thereby recovering from that correction. And last week, we had a little bit of faltering here where the index actually broke below that 50-day simple moving average. And ideally, of course, you want the index to find a life above that. And a lot of that was a hangover, if you will, from Facebook's earnings the prior week and the market's response to that. But in good fashion, Apple came out with very, very solid earnings. We were able to recover this drop below that 50-day as technology shares came back into favor following Apple. That was just the medicine that the market needed, if you will. And so now let's go ahead and take a look at where the strength is in the broader markets currently. And what we can do here, I've already set it up. And this is something that for those of you who've been watching, I do on a weekly basis. We're looking at candle glance, and I've populated this. It allows you to have up to 12 ticker symbols that you can then compare. And this is populated with not only the three main broader indices, the Russell 2000, also with relevant, what I call relevant sectors. So we have technology, industrials, financials, and also we have cyclicals. These are the more heavily populated portions of the broader indices. And then I've also put in the software ETF. It's SKYY, because as many of you may know, within technology, software really had been the leading space. It was an area that was outperforming the broader markets throughout a good part of the recovery process from the correction. But as you can see, here it is, SKYY. It has faltered a bit here recently, and I do just want to take a moment because this is such an important area and a part of identifying the broader markets. You can see this is SKYY, the Cloud Computing ETF, a daily price chart. And this is that excellent strength that we have seen, had seen April into the beginning of July. Now, more recently, the software stocks have faltered, and a lot of that is because of their earnings are coming in, for the most part, exceptional earnings. But because of this outperformance, many of the stocks had very high multiples. They were priced for perfection. So on the good news, the stocks were sold. So from my work, we're in a bit of a critical position. We don't want to lose leadership. That's not a good sign for the broader markets. However, the software stocks are coming back into favor. We are seeing buying rather tepid, but it is just enough to get a lot of these stocks back up above their key 50-day simple moving average. So that is encouraging. But let's go back to that snapshot of the broader indices. And what I've done is added an RSI indicator, which is a relative strength indicator. We're looking at 2-month daily price charts for each of these snapshots. And I've sorted RSI in descending order. So we're looking at strength to weakness. And it really is a quite powerful way to get your arms around where the current strength is in the broader markets. You can see that healthcare is now listed in the forefront, followed by consumer staples, financials, and then we get into the broader market industries, the S&P 500, the Dow, followed by the industrials and the cyclicals. So as we are looking at these areas of strength, I can tell you from someone that is going through thousands of charts each week with an eagle eye on the broader markets, what we're looking at here relative to strength is all about earnings. The groups that are up here in the forefront are actually reporting superior earnings results. Starting with healthcare, it is large cap pharma. We're seeing biotechs come into play. We'll get into how you can uncover this yourself, but this is from my work going through thousands of charts. Consumer staples, interestingly, this is an area that we've covered in the past. Interesting because consumer staples have reversed this downtrend. They've now broken back up above not only their 50, which is the red, the green is 10-day, and the blue is the 200. So this break up above the 200, super constructive. We are now seeing it pull the other simple moving averages upward. So consumer staples are in play now, and there are a lot of individuals that view that primarily as a defensive move. However, consumer staples are filled with consumer-driven growth stocks. And we can drill down and look at some of those because that's where the real strength is. We are seeing bounces in some of these old line soap companies, and they're coming in with good numbers. But the real pocket of strength is the consumer staple, consumer products area. And then we can move on and see that the financials, a lot of the large money center banks, as well as regional banks, continuing to come in with solid earnings reports. So there are a number of stocks in this area that are looking very, very constructively. And then, of course, the industrials, the trade war ping pong, if you will, ball, as far as being unfortunately beholden to any kind of news relating to trade wars. But within industrials, there are bright spots there as well. And a lot of it is transportation, rail stocks. We're seeing trucking, all coming in with superior earnings and driving that grouping up. The consumer cyclicals seem to have fallen asleep here. They had come out with wonderful numbers, and you can see the big advance they've had. And more recently, they are hitting the pause button, but I will argue that they are definitely picking back up. We have a number of consumer stocks. They are due to report this week, so it's going to be very, very telling. So let's go ahead and move in. I wanted to also give a little bit of a backdrop as far as the economy. Last week, unemployment dropped another 0.1%. We're down to 3.9%. Consumer confidence ticked up to a 20-year high last year, and last week. And then we also saw another pickup in consumer spending. All of this very, very constructive for the economy, the GDP, and it will drive what we are seeing as far as where to look in the markets to areas that would benefit from that. So I'm going to take you back to this display here. And what I've done is taken a snapshot. This is from the close last Friday. It is the initial interface page from stockcharts.com. And quite simply what they are doing here, and it is updated throughout the day. This is your top 10 movers in the Dow. You can also get the S&P as well as the NASDAQ. And quite simply, I sort it by the percent up. And I'm pointing this out to you for those of you that may be time constrained. Looking at a screenshot such as this can be really quite powerful if you can just take a couple of seconds each day. So we're looking at the close on Friday, and you sort it by percent change. These are your movers in the Dow. So quite simply, we can see that Pfizer is in here, Merck is in there. So it gives you a sense that the large cap pharma stocks that I talked to you about, these are earnings driven. And so some of the other areas, we're starting to see a little bit of a pickup in the larger retailers, the consumer space. So this is a snapshot that I would urge you to put into your tool belt, if you will, something to pay attention to. And then yet another, this is from the close on Friday. There are preset screens that are predefined, all set for you to access. This particular screen is from Friday. It is stocks hitting a new high in the NASDAQ. And so once you go ahead and access that screen, you can sort it by the scooter. This is a very, very powerful indicator because it's providing you with an outlook as far as the performance technically of those stocks on that list, but it's taking a long view. And while there are components of it that are shorter term, you are getting clear-cut outperformers. And so what you can do from this scooter breakdown, 99 being the highest and so forth, is take a look at the sector groups that are showing up here in the forefront. From there, you can then drill down to those industry subgroupings. So we can see quite clearly healthcare remains dominant. Just simply by eyeballing this, you can see that that is a very strong area in the markets right now. And then you can do the subgroup underlying group look, and you can see that biotech, a lot of the healthcare providers are among these top listings. So this is another way to wrap your arms around where the current strength is in the broader markets. Those stocks that are hitting a new high in price, that is a very, very strong momentum type characteristic to exhibit. So without further ado, what I've done is now we have a sense of where the strength is in the broader markets. We've talked about healthcare, software coming back into play, consumer-driven stocks with consumer spending hitting new highs. So what I've done is taken a look at stocks that are due to report this week, and using that backdrop of the strength in the broader markets, we can now take a look at some of the stocks that appear to be set up to benefit. And Actually, very quickly, I have Wingstop. These guys reported last week. You can see the big gap up. This is one of the stocks from my weekly newsletter, gapped up, but it really is carrying on. It's up another 2.2%. So I have a course that I created over the weekend that looks at stocks. Over 240 stocks have gapped up in response to earnings season so far. There is a way to trade that. Just because it gapped up, it does not mean that the move is over. And you can see that here with Wingstop. So those of you, you can visit my website if you're interested in that. But let's move on and take a look at some of the stocks that are seemingly setting up. They are due to report this week. This is a stock that's going to be reporting after the close today. This is Twilio, a very popular internet stock. And what I wanted to point out to you here is the company is again due to report, but analysts have been revising estimates up going into earnings. That historically can be very, very constructive, but sometimes it is helpful to take a look at a stock and view closely how they responded to prior quarterly earnings. And you can see this stock here, when they reported fourth quarter last year, gapped up and advanced further. And I want to remind you, this was during a very difficult period in the broader markets. It was able to make quite an advance. Their Q1 earnings, another gap up and another advance. Doesn't mean it's going to happen absolutely, but it is all very much worth noting. Let's take another stock here. It is in the consumer space. Crocs, those lovely crocodile type shoes. And so what I wanted to point out, this one is also due, they're actually due to report tomorrow. And a couple of dynamics going on here. One is the earnings estimates for this year are triple digit, 106% for 2018, and analysts are calling for 130% earnings estimated growth for 2019. So very, very powerful. It's about a $1.2 billion company. But here again, we can pay attention to earnings releases going back historically, and the company's response to those earnings have been quite constructive. While we're in the consumer space, let's take a look at another stock that is due to report tomorrow, and this is Fossil Group. For those of you not familiar, they are the creator, among other items, of very popular watches. And so Fossil is another company where earnings estimates going into earnings have been revised upward. We talked about that being positive. The company is about a $1.5 billion company, but here again, let's just take a quick peek of their prior earnings. This is a huge gap up. They reported Q4 earnings, and the stock did go on. This is their first quarter earnings. The stock gapped up and continued to advance. What I like about it is the fact that more recently, in line with a lot of other consumer cyclicals, the stock has hit what I call the pause button, pulled back very orderly, dipped just a little below that 50, but it's coming back. So you have a company that is reporting, but they're not sky high. So we could potentially see a nice pop from them. Again, estimates are being revised going into earnings. And I do have so many stocks. Let's take a look at IPAR. This is another consumer-driven stocks. It's called Inner Parfums, and this particular company is actually due again tomorrow. It's another one where the estimates have been revised upward going forward. So it's a very vibrant market. The cosmetics, the personal care area of the market is and remains very, very vibrant. Now, this one might not be as interesting because the stock really is climbing. It's what I would call priced for perfection, but it is another one that historically has had positive responses to earnings. It is very, very constructive looking. I would perhaps put this on maybe your watch list to see how they actually report, and is it a stock that you can then enter in the event that they do come in with strong earnings. Now, moving away from the consumer area, we talked about healthcare and really medical products. Biotech stocks are really back on the move. A lot of that has to do with the ability for them to now pass products. For clinical trials are moving faster, a little bit less in the way of red tape. There has been funding from the government to support a lot of this testing that's going on. And so within these biotechs, there are a number of medical products companies that provide products to these companies that are developing new drugs. So let's take a look at one of them that is due to report. This is Quiddle, QDEL. And the stock, it's about a $2.5 billion company. And again, they do provide medical products, and they are on track for 2018 for an estimated growth of 150%. Now you can see the stock very clearly has had a strong advance already, all earnings driven, and doesn't mean that the advance will not or cannot continue, because this was another stock where, in line with a lot of these higher flyers, kind of fell a bit here. So we are coming back to prior highs, but it is one that I would keep on your radar screen. BIO is another that's in this healthcare space, and this is a little bit larger. It's a $10 billion company. It's called Biorad Labs, and as stated, they provide products and services to these biotech companies that are, and also the big pharmas that are developing new products. So another huge grower. They're estimated to grow 224% on their earnings this year. So it is actually one that is behaving rather constructively. All of your key moving averages in an uptrend. RSI is positive. So I would put this on your radar. They're due to report on Tuesday. Keep your eye on that one. And then another, there was consumer healthcare and healthcare providers have been very, very strong. This is Tenet Healthcare, THC. It's a $4 billion company, and they're actually due to report today. And it is a hospital. And let's take a look, because the earnings estimated for this year are 93% growth over last year. Estimates are being revised up into earnings, but it's not displayed here. But from my work, I did go ahead and just I took a quick look at the PE of the price to earnings of this stock, and it's at a cheap 23%. And that's relative to Tenet has been able to get a PE as high as 76. So when we look at stocks that when going into earnings, ideally you do not want them necessarily priced, what I say, for perfection. So it does, from that point of view, have a bit of room to go. But take a look at this prior earnings release here in May. The stock gapped up and advanced from there. We also had a positive response here where the stock gapped up. So it does have that history of coming in ahead of estimates, something that you like to see. And then equally important is the fact that all of your key moving averages are in uptrends. You're looking at a healthy stock that has well over 200% growth prospects for this year. So that was worth definitely taking a look at. And then OFIX, this is a smaller company. It's about $1 billion. Orthofix Medical, very much in the way of same phenoms. Although I will say this break is a bit concerning. It's something that would need to catch your eye, because and it was earnings related, so that is going to be a bit concerning. The interesting thing is how the stock was able to recover. So we're just back up to this prior peak, and this particular company is also having revisions upward to going into earnings, and it's in the medical products area. This is a very strong industry group within the markets. And I do have a couple more that we can take a look at that are similarly in these same groups. HSIC, and this is another healthcare company. It's Henry Schein. The estimate's being revised going into it. It's a $12 billion company. And judging by this gap up, it's up 5.5%. It appears as if the company did report before the open today. But you can see how powerful it is for you if you were to go ahead and do this pre-screening, knowing where the strength is, drilling down to companies within those stronger subgroupings, because really these groups that are strong, they are strong for a very sound reason. It's because demand for their products are up. Some of them are getting that funding that we talked about. They are able to provide services to areas that are in a growth phase, such as the biotech. So here is an example of a company. So sure enough, it broke out of this space, came in with earnings, gapped up 5%. So what I had shown you before with Wingstop is something that points out to you that that one-day gap, this gap was up well over 10% last week, but huge volume. That's what you want to see. This is institutions. Oftentimes their position is not going to be filled in one day. So it's up now again 3% today as the stock continues to advance. And moving forward, I do have a couple of other companies that we have not gotten to yet. Again, moving back into that healthcare space, RDNT, and this is RadNet Medical. And one thing I did want to point out, they're due to report on Thursday. It's a medical home care service. And what I wanted to point out to you is the strong expected earnings growth. The company is on track to earn 61%, and that's next year, 2019, huge earnings growth. It's a smaller company. This company is about 700 million. But what really caught my eye here is not only looking back at prior earnings, you like to see a history of coming in ahead of estimates, gapping up, but the fact that the company really pulled back here. It did so on very, very light volume, just a total lack of interest off of everyone's radar. It pulls way back. But now going into earnings, they're due to report on Thursday. We're seeing a bit of a pickup. It's getting more constructive in the sense that the stock is now up above that 10 and now up above that 50. Not quite there yet. The RSI is poised to turn positive. The MACD is not quite there yet, but it is Monday. The company's due to report on Thursday. So I would definitely put this stock on your radar screen. And then as we wind down, one other area, I talked to you about the strength that we are seeing in these some of these trucking stocks. I'll just pull up a couple. Actually, that's not the best example, but a lot of them are in fact doing quite well, hitting new highs. Let me just go to another company, but these are a lot of these transportation companies. It's in line with the fact that we have increased consumer spending. There is a need to move these products. So this is CSX, but more importantly is an add-on business where these companies need travel, they need logistics companies that will help them move these products along. Of course, we go from the rails, from the ship to the rails to the trucks. So we need logistic companies. This is EXPD, it's Expeditors. And this company is due to report tomorrow. Another company where the earnings estimates are being revised going into their report. That is a positive. Take a look at this gap up last reported earnings. The stock did gap up and responded quite positively, so keep an eye on this one. It is in line. This is a stock that I mentioned last week, and a lot of the stocks I mentioned last week had super earnings and did superior to the broader markets. But this is Echo, and it's a global logistics travel transportation logistics company. So just pointing out other stocks that are in that same industry group that are doing well. And that is another good exercise. If you're looking at a stock within a group, you want to get a feel for how its peers are doing, because oftentimes, again, there is a commonality. There's a reason that that particular area of the markets is doing well. I think I have time. Oh, maybe not for one last one. No, we are out of time. And until next week, thank you.